In January 2020, an anonymous group made an extraordinary claim about the fastest-growing coffee chain in China. They said they had watched Luckin Coffee stores for 11,260 hours. Not market research, not app downloads. Cameras pointed at pickup counters from open to close. 620 stores, 981 full store days, 92 full-time observers, and more than 1,400 part-time workers. Then they collected 25,843 customer receipts. Their question was almost insultingly simple. How many cups left the stores, and what did customers actually pay? Luckin's public story implied roughly 495 items per store each day. The anonymous investigators counted about 263. The missing coffee was worth hundreds of millions of dollars. This is the case of a growth company whose digital numbers rose faster than its physical cups, and the investigators who audited an app by sitting in coffee shops and counting bags. Luckin was not a fake business. The stores were real, the coffee was real, the opportunity was real. China had more than 1 billion consumers and far fewer coffee shops per person than mature Western markets. Luckin opened compact pickup stores near offices and universities. Customers ordered in an app. Promotions made the first cup cheap or free. Small footprints made new locations fast to build. The pitch was not simply another cafe. It was a technology company selling coffee. Cashierless ordering, central data, aggressive delivery, and constant digital coupons. Luckin opened its first trial store in October 2017. In May 2019, about 18 months later, it listed on NASDAQ. That speed became the product investors were buying. Store count climbed by the hundreds. Revenue appeared to accelerate. The company looked capable of doing in China what Starbucks had spent decades building elsewhere. But growth stories create a dangerous kind of accounting pressure. A store can be photographed. A cup can be tasted. A transaction inside an app is whatever the database says it is. The anonymous report arrived through short seller Muddy Waters, which said it had received the work from an unknown source and considered it credible. Muddy Waters was betting against Luckin. That financial interest belongs in the frame. So does the report's method. Its authors said they scraped the Luckin app to map stores, then selected locations across 38 cities and different store types. Observers recorded the pickup area for the full operating day. If more than 10 minutes of video was missing, the entire store day was discarded. Analysts counted customers picking up orders and delivery drivers collecting bags. They used the receipts to test a second claim. Not only how many items were sold, but the real selling price after coupons. The sample covered more than 10,000 customers and more than 2,000 stores in 45 cities. The report said the receipts showed an average price near 10 renminbi per item, below the company's guidance, while items per order had declined rather than risen. No spreadsheet model is the memorable part. The memorable part is a camera aimed at a counter. The public numbers lived in a digital system. The short report forced them to reconcile with physical coffee. Luckin rejected the report. It called the methodology flawed, the evidence unsubstantiated, and the allegations misleading and false. For a moment, that defense had support. Other investors pointed to app downloads and the visible pace of store openings. The stores existed. Lines existed. A company growing this quickly could look impossible before it looked inevitable. But during the annual external audit, problems surfaced inside Luckin's records. On March 19, 2020, the board formed a special committee. It hired independent counsel and forensic accountants. On April 2nd, the company disclosed that an internal investigation had found fabricated transactions associated with senior operating personnel. Luckin's shares collapsed. The special committee later said it reviewed more than 550,000 documents from over 60 custodians, interviewed more than 60 witnesses, and performed forensic accounting and data tests. Its July finding was blunt. Fabricated transactions had begun in April 2019. Luckin's 2019 net revenue had been inflated by approximately 2.12 billion renminbi, about $310 million at the time. Costs and expenses had also been inflated by approximately 1.34 billion renminbi. The cameras had not established every part of the fraud, but the central contradiction was real. The reported business was much larger than the business underneath it. The SEC's later complaint described 3 purchasing schemes built around coupons and related parties. Luckin's app made vouchers a normal part of the business. Real customers bought discounted coffee. Real corporate clients could buy coupons in bulk. Inside that legitimate machinery, the SEC alleged employees and connected parties created transactions that looked like customer demand without corresponding retail sales. In early versions, individual accounts tied to employees or related people purchased large quantities of coupons. Later, supposed corporate buyers entered the flow. The largest scheme used third-party companies and sham coupon purchase agreements. False orders could then be generated against the supposed coupon sales and recognized as revenue even when no customer had ordered a drink. Revenue alone would leave an obvious problem. The company would appear implausibly profitable. So the SEC alleged certain employees also inflated expenses by more than $190 million, created a fake operations database, and altered accounting and bank records to mirror the false sales. This was not one imaginary number typed into a quarterly report. It was a balancing act. Fake revenue needed fake activity needed fake costs. The more complete the records became, the more convincing the company looked. Until somebody counted the cups. Luckin terminated its former chief executive, former chief operating officer, and 12 other employees whom the board said participated in or knew about the fabricated transactions. Additional employees were disciplined, and relationships with implicated third parties were ended. NASDAQ delisted the shares in 2020. The SEC charged the company that December, alleging more than $300 million in fabricated retail sales, more than $190 million in inflated expenses, and materially misstated public results. The complaint said Luckin had raised more than $864 million from debt and equity investors during the fraud period. Luckin agreed to a $180 million penalty and permanent injunctions without admitting or denying the SEC's allegations. The company entered a Cayman restructuring recognized under Chapter 15 in the United States. Investors pursued claims. The old growth story was dismantled, restated, and paid for. In most case files, that is the ending. Luckin's ending is stranger. The stores did not disappear. New management kept the pickup model, the app, the coupons, and the supply chain. Luckin restructured, repaired controls, and continued opening locations. By the end of 2025, the company reported 31,048 stores worldwide. It reported more than $7 billion in annual revenue, 94 million average monthly transacting customers, and more than $900 million in store-level operating profit from self-operated locations. It also had 9 stores in the United States. The same company delisted from NASDAQ after one of the most spectacular accounting scandals of its era had returned to New York, not as a stock, but as a coffee shop. That does not erase the fraud. It makes the case more useful. The underlying product can be real while the reported growth is false. A company can survive misconduct that destroys investors. A broken set of numbers does not always mean a broken customer proposition. It means those are separate questions, and both must be tested. The anonymous report was a short thesis, not a court judgment. Its authors had an incentive to find failure, and Luckin disputed its methods. But they understood one thing every digital business eventually confronts. Databases describe reality. They are not reality. If an app says 495 items left a store, someone should be able to watch 495 items leave. If a revenue chart rises, cash, inventory, customers, and delivery traffic should rise with it. So write the rule in the ledger. When growth lives inside a system, reconcile the system with the street. At Frank, one test email exposed millions of customers who were not there. At Luckin, cameras and receipts exposed coffee nobody drank. The tools changed, the audit did not. The primary records are linked below. Next on the ledger, the crypto exchange whose founder died holding the passwords and the wallets that moved after his death.